There are times in markets when the real story is not the price you see on your screen, but the imbalance quietly building underneath it. What I am about to walk you through is not speculation, not rumor, not theory. It is official data that reveals something deeply uncomfortable about the silver market in 2026. And once you understand the math, you will see why the current price does not reflect stability. It reflects tension, it reflects distortion, it reflects a system that is operating on borrowed inventory. The most recent outlook released by the Silver Institute, prepared in collaboration with Metals Focus, outlines a reality that is almost entirely absent from mainstream coverage. This is the global authority on silver supply and demand data. These numbers are not pulled from internet commentary. They are compiled from mine production reports, industrial fabrication surveys, investment flows, and trade statistics across the world. And the central message of that report is simple but profound. The global silver market is projected to record its sixth consecutive annual deficit in 2026. 6 straight years where demand has exceeded supply. 6 years in which more silver was consumed than mined. 6 years where the difference had to be filled by drawing down above-ground inventories that had been accumulated over decades. For 2026 specifically, the deficit is forecast at 67 million ounces. Pause for a moment and consider what that actually means. In a market where total supply is expected to reach approximately 1.05 billion ounces, a 67 million ounce shortfall is not trivial. It is not statistical noise. It is a structural imbalance that compounds over time, because this is not happening in isolation. Since 2021, the market has remained in deficit every single year. Add those annual shortfalls together, and the cumulative drawdown is approaching 400 million ounces, nearly 400 million ounces of silver that did not come from mines, nearly 400 million ounces that had to be sourced from stockpiles sitting in vaults in London, New York, and Zurich. Inventories can absorb deficits for a while. That is their purpose, but they are finite. Each year the deficit persists, the buffer shrinks. Each year consumption exceeds production, the cushion becomes thinner. At some point, the market must respond. Either demand is destroyed, or price rises high enough to incentivize new supply. So far, the adjustment has been gradual and volatile rather than decisive. The recent behavior of the market reflects that tension. In China, a listed silver fund was forced to suspend trading for an hour. For 60 minutes, investors could neither buy nor sell. When trading resumed, the price immediately fell by the maximum permitted 10%. That kind of event does not occur in calm, balanced markets. It occurs when liquidity is stretched and volatility overwhelms order books. Look at the broader price action. Gold has risen nearly 4% in a single session after falling by a similar magnitude the day before. Silver surged 10% on a Friday after dropping sharply earlier in the week. Gold traded above $5,000 per ounce, then corrected roughly $400 before stabilizing. Silver touched $80, fell toward $60, then rebounded back above $80. These are not the movements of a system in equilibrium. They are signs of a pricing mechanism under strain. In January 2026, silver breached $100 per ounce for the first time in history. That psychological threshold had been watched by technicians for years. When it finally broke, another signal followed. The gold-to-silver ratio collapsed below 50. That had not occurred since 2012. For context, during 2020, the ratio spent extended periods above 100. It hovered in the 70s and 80s for years afterward. A move below 50 reflects significant relative outperformance by silver. Why does that matter? Because ratio compression suggests that investors are reassessing value. Silver historically carries more volatility than gold, but it also carries greater leverage when supply tightens. As the ratio falls, it indicates capital rotating more aggressively into silver. Now examine demand more closely. Physical investment demand is projected to surge 20% in 2026 to approximately 227 million ounces. That would represent a 3-year high. After 3 consecutive years of decline, Western physical investment is expected to rebound strongly. The drivers are not mysterious. Gold at record levels has redirected attention towards silver. Persistent macroeconomic uncertainty has revived interest in tangible assets. Investors seeking inflation protection and monetary hedges are diversifying into the more undervalued metal. India remains an important contributor as well. Physical investment demand there is expected to build on substantial gains from the previous year. Indian investors have long favored hard assets as a store of value outside the banking system. Even at elevated prices, accumulation continues. Industrial demand remains substantial despite modest efficiency gains. The Silver Institute forecasts approximately 650 million ounces of industrial fabrication in 2026. That figure represents only a slight decline of about 2% year over year. Some of the reduction stems from substitution in the photovoltaic sector, where manufacturers are using less silver per solar panel. However, structural growth trends continue to support overall consumption. Data centers, artificial intelligence infrastructure, electric vehicles, 5G networks, and defense applications all require silver's conductive and reflective properties. Each new AI server cluster demands material. Each expansion of high-speed telecommunications infrastructure consumes additional silver. The global shift toward digitalization and electrification is materially intensive. Even with incremental thrifting in specific segments, the aggregate industrial demand profile remains historically elevated. Combine that with rising investment demand, and you have a powerful force on the demand side. Now return to supply. Total global supply is forecast to increase by only 1.5% in 2026, reaching roughly 1.05 billion ounces. Mine production is expected to grow by approximately 1% to around 820 million ounces. That pace of growth barely offsets the structural deficit that has persisted for half a decade. And remember, silver supply is largely a byproduct of copper, zinc, lead, and gold mining. Roughly 70% of global silver output is not produced by primary silver mines. That means silver production does not respond directly to silver prices. Even if silver rallies sharply, supply cannot expand overnight. This structural inflexibility is critical. Because when demand consistently exceeds supply and inventories are steadily drawn down, the system moves closer to a threshold. Volatility increases, price swings widen, paper contracts struggle to anchor expectations when physical stocks tighten. 6 consecutive years of deficit, a projected 67 million ounce shortfall in 2026, nearly 400 million ounces cumulatively absorbed from inventories, investment demand surging 20%, industrial demand near 650 million ounces, limited supply growth. These are not isolated statistics, they are components of a single narrative, a market under pressure, a buffer shrinking, and a pricing mechanism that has not fully adjusted to physical reality. That is where the silver market stands today. Now shift your attention fully to the supply mechanics, because this is where the imbalance becomes structural rather than cyclical. Total global silver supply in 2026 is forecast to increase by approximately 1.5%, bringing total availability to around 1.05 billion ounces. At first glance, that sounds like growth, but in the context of 6 consecutive annual deficits, it is barely meaningful. It does not restore inventories. It does not erase cumulative shortfalls. It simply slows the pace at which the buffer is being depleted. Mine production itself is projected to rise by roughly 1% to approximately 820 million ounces. That level of expansion is modest by any historical standard. More importantly, silver is not primarily a standalone mining product. Nearly 70% of global silver output is produced as a byproduct of other mining operations, particularly copper, zinc, lead, and gold mines. That fact changes everything. Because when silver is a byproduct, its supply does not respond directly to its own price. If silver doubles in value, operators cannot instantly expand production unless the economics of the primary metal justify it. If copper prices are weak, copper miners may slow production even if silver is surging. If zinc or lead operations become uneconomic, silver supply contracts as a side effect. The responsiveness that exists in other commodity markets simply does not exist here. This creates a rigid supply structure. Zinc and lead markets have faced pricing pressure, introducing downside risks for certain mining operations. Should base metal producers reduce output, silver supply declines alongside them. Even if silver prices are elevated, production cannot be scaled up independently in the short term. That structural constraint limits the market's ability to correct deficits quickly. Geographical concentration adds further complexity. Mexico remains the world's largest silver producer, and much of the projected supply growth in 2026 is expected to originate from primary silver mines located there. However, Mexico carries regulatory and political uncertainties that can affect mining policy and permitting. Any disruption in that region reverberates globally. Peru, another major producer, is forecast to experience declining output from some key operations. While new projects in Canada and Morocco are contributing incremental gains, they are not large enough to transform the overall supply landscape. The result is modest growth layered on top of persistent structural shortages. Meanwhile, recycling is projected to increase by approximately 7% in 2026, pushing volumes beyond 200 million ounces for the first time since 2012. Higher prices naturally encourage scrap recovery. Individuals sell old silver jewelry, silverware, and industrial scrap when valuations rise. This recycled supply helps offset part of the deficit, but recycling is reactive. It responds to price rather than stabilizing it. Even with recycling reaching multi-year highs, the market remains in deficit. That is the key takeaway. The additional 200 million ounces of recycled material still does not eliminate the projected 67 million ounce shortfall for 2026. The market continues to depend on above-ground inventories to bridge the gap, and those inventories have already been drawn down significantly over the past 6 years. When deficits persist for half a decade, the cumulative effect becomes material. Nearly 400 million ounces have been absorbed from stockpiles since 2021. Every ounce withdrawn reduces flexibility. Every year of imbalance narrows the margin of safety. This tightening backdrop is visible in market behavior. Commerzbank recently noted that precious metals have experienced exceptionally high volatility in recent sessions. Gold has moved up nearly 4% in a single day, after falling by a similar magnitude the prior session. Silver has surged 10% following sharp declines earlier in the week. Gold exchange traded funds recorded outflows of approximately 20 tons during 1 week, marking the largest weekly outflow since October. These movements reflect uncertainty, but they also reflect strain. Volatility often increases when a long-standing equilibrium begins to fracture. For years, silver traded within defined ranges, supported by confidence in paper contracts and ample inventory. Now, as inventories tighten and deficits persist, price swings widen. Physical liquidity in London remains a focal point. London serves as the primary hub for global silver pricing and settlement. The Silver Institute's outlook specifically mentions that physical liquidity in the London silver market may remain relatively tight. That is not a minor detail. When liquidity tightens at the core of the pricing system, volatility becomes a natural consequence. The global market continues to rely on the release of bullion from above-ground inventories to meet demand. That process has been ongoing for 6 years. It cannot continue indefinitely without affecting price discovery. Exchange-traded product holdings provide further insight. Global ETP holdings are estimated at approximately 1.31 billion ounces. That represents a substantial quantity of silver effectively removed from immediate circulation and held on behalf of investors. Despite periodic outflows during volatile sessions, overall holdings remain near historic highs. In recent weeks, silver ETFs recorded net inflows of roughly 700 tons. This pattern indicates accumulation rather than abandonment. Even amid sharp corrections, capital continues to flow into the sector. Long-term investors appear focused on structural fundamentals rather than short-term price swings. Macro conditions reinforce the environment. Elevated geopolitical tensions persist globally. Concerns surrounding the independence of the Federal Reserve have intensified as leadership transitions approach. Policy uncertainty in the United States remains elevated, with shifting trade dynamics, tariff discussions, and fiscal debates contributing to instability. These factors historically support demand for hard assets. The Silver Institute explicitly states that the global economic and geopolitical backdrop is likely to remain supportive for precious metals prices in 2026. It also notes that projected strength in gold should help limit downside risks for silver. At the same time, it acknowledges that heightened volatility is expected to remain a defining feature. This combination of tight physical liquidity, persistent deficits, supportive macro conditions, and limited supply growth forms a cohesive narrative. The system is not broken, but it is under pressure. Supply cannot expand rapidly due to byproduct dependence. Recycling, while meaningful, cannot eliminate structural imbalances. Jewelry and silverware demand may decline under price pressure, but industrial and investment demand remain robust. Above-ground inventories continue to absorb the difference, yet those inventories are finite. Volatility should be viewed through this lens. Rapid price swings do not negate deficits. They do not replenish stockpiles. They reflect the market searching for a new equilibrium in an environment where physical constraints are increasingly relevant. Each additional year of deficit compounds the issue. Each additional ounce withdrawn from inventory tightens the system further. At some threshold, price must adjust sufficiently to either stimulate meaningful new supply or suppress structural demand categories. Until then, the imbalance remains embedded. A projected 67 million ounce deficit in 2026 may seem manageable in isolation, but layered on top of nearly 400 million ounces already absorbed from inventories, it becomes more consequential. Supply growth of 1.5% does not restore equilibrium. Recycling exceeding 200 million ounces does not eliminate the gap. ETP holdings near 1.31 billion ounces demonstrate continued investor participation. Tight liquidity in London signals physical constraint. The data describe a market operating with diminishing buffers and increasing sensitivity. That is the environment defining silver's supply side as 2026 unfolds. Now look closely at the categories of demand that respond most visibly to price, because they show you how the adjustment mechanism is already unfolding in real time. Jewelry demand is projected to decline by more than 9% in 2026, falling to approximately 178 million ounces. That would mark the lowest level since 2020. The explanation is straightforward. When prices reach record highs, discretionary consumption contracts. Silver jewelry purchases are highly sensitive to price, especially in major markets like India. In India, silver jewelry often serves both decorative and savings purposes. When prices are attractive, buying accelerates. When prices rise sharply, households postpone purchases or reduce volumes. That dynamic is now visible in the projections. Elevated prices are curtailing consumption in most major markets, with India leading the decline. Silverware demand is forecast to contract even more aggressively, declining by roughly 17% in 2026. Again, the effect is concentrated in India, where silver plates, cups, and ceremonial items are traditionally purchased during favorable price environments. As valuations rise, these purchases become less frequent. Families substitute alternative materials or delay acquisition. This contraction might appear bearish at first glance. It is not. It demonstrates that the price mechanism is functioning. Higher prices are rationing the most discretionary segments of demand. The silver that would have been used for ornamental purposes becomes available for structural applications. And despite that demand destruction, the market remains in deficit. Even with jewelry demand at multi-year lows and silverware demand falling sharply, total consumption still exceeds total supply by an estimated 67 million ounces in 2026. That is the key point. If the most price-sensitive categories have already adjusted and the deficit persists, it means the remaining demand components are significantly more resilient. Industrial demand remains substantial. Approximately 650 million ounces of silver are forecast for industrial fabrication in 2026, although that represents a modest 2% decline year over year due primarily to substitution in photovoltaic manufacturing. The absolute level remains historically high. Efficiency gains in solar panel production have reduced the amount of silver required per unit, but that efficiency is partially offset by growth in other sectors. Data centers powering artificial intelligence models require silver for conductivity and circuitry. Electric vehicles depend on silver for electrical systems and battery management. Expansion of 5G infrastructure demands silver in high-frequency components. Defense applications and advanced electronics consume additional material. These trends are structural rather than cyclical. They are embedded in long-term technological transformation. At the same time, physical investment demand is projected to surge 20% in 2026, reaching approximately 227 million ounces. That represents a 3-year high. After 3 consecutive years of decline, Western investment demand is expected to rebound sharply. Exceptional price performance, coupled with ongoing macroeconomic uncertainty, has reignited investor interest. Gold trading above $5,000 per ounce has redirected attention towards silver as a comparatively undervalued alternative. Investors seeking monetary hedges and inflation protection are diversifying. India continues to build on substantial physical investment gains from the prior year. The preference for tangible assets outside the financial system remains deeply rooted. China presents an interesting exception within jewelry demand trends. While most markets are experiencing declines, Chinese jewelry demand is anticipated to edge higher. Product innovation and the growing popularity of gold-plated silver jewelry are supporting consumption. This allows buyers to achieve the aesthetic of gold at a lower cost, while maintaining exposure to precious metal content. It reflects adaptation rather than retreat. Now assemble the complete framework. 6 consecutive years of deficit have reduced above-ground inventories by nearly 400 million ounces. A projected 67 million ounce shortfall in 2026 continues that trend. Total supply is forecast to grow by only 1.5%. Mine production rises just 1% to roughly 820 million ounces. Recycling surpasses 200 million ounces, but fails to eliminate the gap. Investment demand increases 20%. Industrial fabrication remains near 650 million ounces. Jewelry and silverware demand contract under price pressure, yet the overall deficit persists. Meanwhile, volatility intensifies. Gold swings 4% in a single session. Silver surges 10% within days. A Chinese silver fund suspends trading for an hour before reopening at the maximum allowed decline of 10%. The gold-to-silver ratio collapses below 50 for the first time since 2012, after spending years above 70 and even exceeding 100 during 2020. These are not random fluctuations. They are signals of transition. The macro backdrop reinforces the environment. Elevated geopolitical tensions remain unresolved. Concerns about central bank independence, particularly regarding the Federal Reserve, continue to surface. Policy uncertainty in the United States persists amid shifting trade policies and fiscal debates. The Silver Institute explicitly states that the global economic and geopolitical environment is likely to remain supportive for precious metals prices in 2026. It also notes that tight physical liquidity in London may continue and that projected strength in gold should limit downside risks for silver, even though volatility is expected to remain elevated. This combination of structural deficit, constrained supply, resilient industrial demand, accelerating investment interest, and supportive macro conditions creates a clear trajectory. The only uncertainty lies in timing. Markets can operate with imbalances for extended periods if confidence in paper pricing structures remains intact, But persistent deficits gradually erode that confidence. Each ounce withdrawn from inventory narrows the margin for error. Each year of imbalance reduces the buffer available to absorb shocks. At some point, price must reconcile physical scarcity. Either demand weakens dramatically across structural categories, or prices rise sufficiently to encourage meaningful new supply. Given silver's byproduct nature, rapid supply expansion is unlikely. Given the technological and monetary drivers supporting demand, a sharp collapse in structural consumption also appears unlikely. That leaves repricing as the probable mechanism. Not necessarily in a straight line, not without volatility, but structurally upward over time as the market adjusts to tightening conditions. The data from the industry's leading authority describe a system under pressure rather than one in equilibrium. 6 years of deficit are not temporary anomalies. They represent a sustained imbalance. A projected 67 million ounce shortfall in 2026 extends that imbalance. Investment demand growth of 20% reinforces it. Industrial consumption near 650 million ounces anchors it. Limited supply growth constrains relief. Volatility may dominate headlines. But the deeper narrative lies within supply and demand mathematics. And mathematics does not respond to sentiment, it responds to scarcity. That is the structural reality shaping the silver market as 2026 unfolds.